Hello, this is Wendy Kirkland. This is our third and final DVD. I will be going over the last couple strategies and then try to tie everything together for you. The chart indicators are going to be exactly the same for these patterns as they were on the previous ones that we talked about in the first DVD and the second DVD. We will be using the same EMAs, the 8, 13, 21 as short-term EMAs, the 55 as kind of a middle range, and the 89, 144, and 233 is the longer range EMAs. The pivot points will be added. There will be a relative strength index, the CCI, the ADX, the PPO, and then another ADX toward the bottom. We're going to discuss the weekly option trade. This is a morning trade, and it doesn't work out every single morning, but you have stops in place and you have certain rules and guidelines that are going to either protect you from there being a great loss if it doesn't play out, or it's going to keep you from getting into a trade from the get-go. So this trade is based on a 10-minute chart, and what you're going to watch for is the first three candles, the opening candles in the morning. And this sets your range for entering a trade. And so if we look at this chart and we come over here to the February 27th, the first day here on the chart, the first three candles, we're going to mark the top and the bottoms of those first three, and we are going to wait to see what direction the market goes in after that period of time. Sometimes there's often a morning pullback, and so if it looks like it's heading up for the day, and here we have the EMAs lined up in uptrending order, which would make us think that, okay, this is going to be an up day. We wait until there is a cross of the high of the highest of those three candles plus a nickel. So you want to make sure that it's not one of those little skids that I keep talking about, that you want to make sure that it really seems like it's going to be heading in that direction. In this case, you would be buying the weekly calls. You would be buying the front week weekly call, because you know that you're only going to stay in this trade for the morning. And so the premium on this is, depending on what day of the week it is, it's going to be reasonable, and you're going to be able to buy a number of contracts, and perhaps it's you would do 10 contracts or 20, but you don't want to get your fees up too high, and that information is covered in the book. We're really focusing on the pattern itself, and you would stay in this trade until 11:30, and that really is the time that we're setting as an exit. And the reason for this is that there often is a lunch period where traders and market makers and the people involved in the stock market head out for lunch, and they usually stay out until the afternoon session, which doesn't really start until about 2 o'clock. And so rather than hold during a lunch period drop where there's not a lot of trading going on, you're going to go ahead and take your profit, whatever it is that you have, by 11:30. So here we would enter this trade as it moved 5 cents above the high of the first three candles, and then we are going to exit at 11:30. So that's right in this area. So let's see what happened on the next day. This is our first candle, second one, and then there's a little one that's this little red one. And so here it actually popped above the high and then instantly went right back again. So you might not have even been filled in the time period that it took for that to go up and back down again. But if you were, you then, as it pulled back into this range, you would have closed your trade out and you would have had a small loss, which would have been primarily the fees to open and close the trade out. And that's it for that day. You don't, there isn't a second entry or anything. That trade just did not work out for that day, and it never did drop below, not until the very end of the day. It never did drop below the low of that morning. On the trade on March 1st, you have one candle, two candles, three candles. So that's the high, this is the low, and you would have entered here as it popped above the that would have been an entry 5 cents above the high of the three candles, and you would have exited right in this area as it became 11:30. This trade we have 1, 2, 3, and for 6 candles it never popped above or popped below the 3 candles of the morning open, and so there's no trade that day. If something doesn't happen within the first 6 candles, it doesn't make sense to get in at 11 o'clock and then exit at 11:30. So there's just no trade that day. On the 5th trade here on March 5th, we have our first 3 candles, this one, 2 little red ones, and so we wait to see if it's going to go above the high here, and it did at this point, higher than a nickel, and then we're going to stay in and we get out at 11:30, which is just right in this area here. And so if we look back, this first trade made a 47-cent profit gain, and that's pretty nice for being in a trade for a couple hours, that I can mentally do the math here and think that if I purchased an option that was at the money, that the delta would have been at least 50, and so that means that I'm going to make half of whatever this profit gain was, so that I can figure that I made anywhere between 25, 23, 25 cents, and probably even a little more than that, because as the price went up, so too did my delta go up. So that I would estimate that I probably would have made 25 cents of that 47 cents. And if I purchased 10 contracts, that would mean that I made $250 in just that one trade that lasted just a couple hours, not even a couple hours, hour and a half or so. On the second trade, as I mentioned, that one might not even have been filled, or if it had, you would have been out your trading fees and just a little bit within the time that it was open. On the third trade here, it's noted that there was 41-cent move in that, and again I would do that same math and I would figure that I'm going to have had a delta of 50, which means I make half of what the price move is, and so that's at least 20 cents, and it probably would be a couple pennies more than that because the delta would have increased while the price was going up. And had I bought 10 contracts, that would have been $200. So that's kind of the way that I think about this morning trade. It's not something that is going to be get rich trade, and it doesn't always work out. That the winners are much higher than the losers, and so I can justify that if I do have a losing trade, I have my rules in place and I get out and I cut my losses short. But I can often have 2 or 3 trades a week, make a couple $100 each day. That is like a paycheck, and I can not do anything else for the rest of the day. This can be my trading strategy, or it can be one strategy that I partake in while I have another longer term strategy that I'm playing out. I could be have a 60-minute trade on a squeeze playing out while I participate in this morning strategy. So you can, depending on what you have going on in your day and in your week and whatever your trading style is, you can have a number of these different strategies working at the same time. On the fourth trade here, I had said that there was no trade within the 6 candles, so there was no trade that day. On the 5th one, there was just a small move before we exited at 11:30. There was a 10 cent gain. So here my delta again would have been 50 at least, and so I would have made half of that. That's a 5 cent move. If I had 10 contracts, that's $50. You know, it's not a lot, but it's more than enough to pay my fees, and I made just a little bit, and I participated in the game for the day. Now I'm pointing out here that the reason behind this particular chart is that there are times that the Qs can trade in a range. It's not just the Qs. It can be the indexes. It could be the any trade. It could be Apple, which is a big part of the Qs, that is trading in a tight range. And when this is happening, you're aware of it. You look at the charts, you look at the patterns, you can look at the dailies and see that they're up and down and just doing little candles all in a row. This could be a time that you just decide that this is not, you're not going to participate in the morning strategy or in the strategy that we're going to be discussing next. That you can see by the diagram here that it has been trading in a tight range of like 30 cents back and forth, and unless you're very quick on the trigger as far as getting in and getting out, 30 cents by the time you pay your fees and based on the number of contracts that you are getting and selecting to purchase, it might be better to just stand aside and wait until the Qs, you know, at least in this time frame, break out of the trading range that they are in, and that there's a little bit more volatility where the price is moving in greater strides up and down. We're going to look at a particular trade here that you can see that you have the first 3 candles. So this is the low, this is the high. We're going to wait for 5 cents below this low mark. Didn't quite do it here, and so this is our entry. We are going to exit when the price crosses back above the 3rd candle back. Now I have to do it different ways sometimes. That I could say that this is the low of the 3rd candle back, and so as soon as the price moves above this, that would be the exit. Well, if that were the case, then this exit would have happened right here. So that this is the low of the 3rd candle back, and you would have exited right here. There are times that I give it more the benefit of the doubt, and I actually go with the candlestick rather than the wick, and wait to sit and see if it will go back above this point, because this is also a the S2 support level, thinking that it might get up there and bounce back. So I kind of take what's happening as a whole into the picture here. This wasn't able to get above that level, and I might think that it would drop back further, but getting out here would protect and give me the most profit. So sometimes it pays to follow the rules and not stretch them and try to scoot by. I'm going to point out, just because I can't help it, that you have this squeeze here on this 10-minute chart. And I don't think we've looked at 10-minute charts with regard to this time frame. So you have a squeeze here, you have the PPO cross, you've got the DI heading up, the lines are spreading apart, and just now the ADX line is heading up to support this plus DI trend and going into the stage 6 sweet spot. And we can see that now where we've got some strength behind the upward move, where this was rather flattened in a trading range for the day. Now this is just a 1 day kind of squeeze. It's elongated and has taken the whole day to play out, and this is happening right here at the end of the day. But I would pretty much bet that tomorrow will go up, and this will continue and play out at this point, because we're entering into the 6th stage, the adult stage. You have the EMAs that are crossing up over the longer term EMAs. It's overbought. Look at that nice volume. So anyway, let's get back to this trade, and you can see that we made a little bit of profit. So we'll see how this played out. That had we entered, we're going to be able to buy the current weekly, and if we'd entered on March 7th and we purchased the March 2013 69.50 strike calls, the premium was 63 cents. There was just 1 day until expiration. The delta was 43. It wasn't quite 50, but it was close enough to be able for me to do the math. The first exit on March 7th, as it moved beyond the bottom price of the third candle, the premium was 95 cents. That's a profit of 40 cents, or 34%. The delta then at the time of the exit was 100. So that meant for every penny move, your option profited a penny. And there was still 1 day left before expiration. The second exit, that would actually have been the 11:30 exit then, rather than using the third candle back, the premium we gave up 2 cents, and it was 93 cents, or a profit of 30 cents, or 32%. The delta was 100, and of course there was still just the 1 day left till expiration. So here, by following the trailing stop, in a sense, by trading and closing the trade on the third candle back at the low, we gain some extra premium by following the rules. That it was a dime difference here, and depending on how many contracts you had, that could have been $10, and if you had 10 contracts, or it would have been $1, and if you had 10 contracts, it would have been $10. So it would have maybe paid one side of your trading costs, your commission. Next, we're going to discuss the fin strategy, and this is using and putting emphasis on the CCI, which is one of the indicators that we've been looking at for overbought and oversold, overbought, oversold. And what this is in a sense trading the fins, trading them as they drop below 100, exiting down here when they become oversold, entering here as they rise, and so on. So let's look and see what we have. That here, as it crossed down below the 100 line, we would have entered a put. Here, as it rose above the minus 100 line, we would actually have exited the put and entered calls. It rises up here. It barely touched, and in this case I'm pointing out that you could actually have held. That's not much of a peak, and you could have held because of the other things that you know about the indicators, and that was that this plus DI line was still in control, and so that you can assume that there's going to be more upside. But not only that, you could look down here and see that there was a P3 unfolding, and because you have learned about the stages, you are seeing this taking place here. You're wondering what to do. Should I get out here, or should I hold and give it a chance to become more overbought on the CCI indicator? And you look down here, and what do you see? You see this P3 is unfolding, and this is a PPO wobble. It's the toddler stage. You can then see what happened, that it went into now the adult stage of the P3 squeeze, and sure enough you had this pop in price, and then it went flat. So you are going to exit here when you're exiting the calls, and you could actually enter puts for the ride to the downside. And that's the point of this strategy, is you are kind of riding the waves. That I call them fins because these look like shark fins, or fins of fish that, break in the water or below the water. And so we exited the calls here as it dropped below 100. It actually had this other little burst back up again and then drop further. And at the point that you entered or exited your calls, you could buy puts and run down for the downtrend. On the RSI, you are seeing that there is divergence, the lower lows taking place here, that confirms that there's going to be a move to the downside. We can see that the plus DI is rising. I'm sorry, the minus DI is rising on this drop down. We've had the PPO cross, which is the expiration of the squeeze that started here that helped with the uptrend. And so this is a confirmation that we are following the rules and getting out of our calls here as this drops down, but we're seeing confirmation with a weakness of the PPO as it drops. We're seeing the curve, the rollover of the ADX, and we know what that means within this pattern, that this is the final stage. So it doesn't make sense to hang on and hope that this is going to go back up, or that there's going to be more rise before there is actually a drop. We can see it coming on the indicators. So we can enter puts here, and then based on the CCI we can exit at this point as it rises above the minus 100 line. And now the moves all of a sudden are becoming shorter. That if you'd entered calls here, you're going to hold them through this, assuming that eventually it's going to get up here to being overbought and have the overbought fin, and this is where you would exit. But you may at this point decide to step aside and not enter every single one of these swings up and down until there again is more decisiveness, more volatility, where there is going to be deeper fins instead of these super quick swings. And because we know about the ADX lines and the DI lines here, we can see them swinging back and forth and braiding, as I call it. And you will begin to see and notice that this taking place, that there's less of the big dips between them. They're getting tighter and tighter in here. It doesn't look like this, where it goes ways up and then moseys down. This is way down and it goes up and stays in control for a period of time, or loses control for a period of time. That the moves get shallower, they get tighter, and this is a period of time of indecision, that the ADX line is not heading straight up or straight down. It's going flat and the lines are twisting and turning. And this is a time of indecision. There are little moves here as it goes up and down, but you have to be mighty quick. And to be making 10 cents or 15 cents and tying up money for that, even just those couple hours, unless you just have nothing better to do, it's sometimes better to stand aside during these periods and just go on and study some other trade that is having longer moves, and come back to this when it's not trading so tight. Okay, this is a specific trade that we're going to discuss, just so that I like showing what the potential is. That here we're entering here as it's coming out from being oversold. So this is our entry, that the price was lower. We're getting in as it comes up above this S1. It's also the 144 EMA line, which has been support. So it dropped down and now it's popping back up again above that again. And so this is the area that we are entering right in here. And you can see I just love the EMAs. They make me happy. That here you can see as it dropped here, that how we had these short-term EMAs drop over the pink line, the 55 line, and how they work as a unit. And now, as we're into our trade, they have moved as a unit and are up above the longer-term EMAs and are like ribbons in ascending order. Here we had a little bit of a drop in the CCI, and this is where we exit. We didn't know that was maybe going to be just a shallow blip here, that we're following the rules. As it broke down below the 100 line, this is the area that we get out. And it did pop up, but that's just what happened. Here again we can see that this was a squeeze, and we have a little bit of a wobble, another wobble, and because we had these two others and this started curling down, there's no way that we could have known whether this was going to be a bounce off of a PPO or a cross. And if you waited for a cross, it would have happened down here somewhere, and you would have given up a great deal of the profit that you had. So for this strategy, we can get the support of seeing what's happening in these other patterns that we're beginning to recognize, and we can use that information, but we follow the rules of the strategy, and the strategy rules have to do with the CCI dropping above and below the 100 lines. So in this trade, we entered on March 11th. We purchased the March 2013 6750 strike calls. The premium was 57 cents. There's 4 days left till expiration, and the delta was 44. We exited on the same day, and the premium was $1.43. There's still 4 days till expiration. At this point, the delta had risen and was now 97 cents. It increased with the increase in the price of the equity, and that is a profit of 151%. So we're wrapping things up here. We've covered all of the different strategies that were covered in the book. I hope that by looking at a number of charts and talking about how you can see the different patterns, even when you're trading something different. You're trading one pattern, but you can see the pattern from another strategy, and how that information can be supportive in your decisions to enter and exit a trade, that this is all beginning to form a very clear picture. And as I said a little bit earlier, the time that you have to trade is a variable. That you could have a dance recital to go to on Thursday, and so that you're not day trading that day. You might never have time to sit and watch the computer for several hours a day, and so then you trade leaps or monthly options where you're buying 2 or 3 months out. Perhaps you do have the morning hours that are open, and then you have some other obligation in the afternoon. So the morning trade is perfect for you. Or if a fin trade is setting up, that's a perfect vehicle for you to trade. So just trading this one equity of the Qs, because of its liquidity and easy to get in and out, there's no question about that you're going to be filled instantly when you place your orders. There is something for everyone, and most of the time there's a variety that can be traded by all traders. That you might be in one kind of trade during this part of the week, and another one of the strategies during another part of the week, and you can combine. You can be in several different trades at the same time. There can be the longer term trades that you're watching and letting them develop, and at the same time you have one or two of the other strategies that you're able to participate in on a daily basis or a couple times a week. And trading the Qs, I find that I always can find a trade. It's not that there's ever a time period where it's just dried up and nothing is happening. There's times now where you can have a period of consolidation, and so you're not trading a 10-minute chart, or you're not trading a 15-minute chart because it's going flat for a number of days in a row. But that doesn't mean that that's what's appearing on the daily chart. You could have a daily chart that is forming a squeeze, and these periods of consolidation that you're seeing happen on a 10-minute chart or a 15-minute chart are the wobbles that are taking place on the daily chart. And so that squeeze on the daily chart is a viable trade, and it's still going to play out. But what you're seeing on the intraday charts is not a viable time to be trading that time frame. So again, as a review, you have leaps, and they expire in January of the following year, and you can purchase several years ahead. So if you're interested in trading one of the patterns like a P3 or a P3.5 and don't have a great deal of time to focus on charts on a regular basis, you just want to look at it once a week or every couple of weeks, that leaps might be just the right vehicle for you to participate in. Front month options are the current month, and they expire on the third Friday of the calendar month. Monthly options are available out in the future, and most often they are traded using a daily and weekly trend trade, so that the book covers the strategies, the P3, P3.5, 813, the M's, the W's, and the variations can be used using monthly options. And again, it's often wise to buy more time than you figure you will be using, so that you're allowing for any contingencies that take place, and that you don't run out of time and your pattern is just getting started to unfold. In the examples that we used, there was a number of them where P3 squeeze started, re-squeezed, started, re-squeezed, and you want to be able to allow for that. Of course, you could exit when the PPO crosses down, and that's the prudent thing to do is you have your exits in place that you're going to close a trade, but you want to be able to allow for those times when it takes longer for the trade to actually develop, where maybe you have 2 or 3 of those wobbles and the stage 5s where the PPO line touches and then bounces off, and yet it takes a while for it to get into that adult stage, the 6th stage where it runs parallel. So you want to allow yourself plenty of time for anything to come up. Now the front weekly options they come out on Thursdays. So you have Thursday and Friday of the current week, and then you have Monday through Friday of the next week. So that gives you between 7 to 1 days to trade the front weekly options. And just recently they have allowed the exchanges to start listing consecutive weekly options, and some equities offer up to 5 consecutive weeks. Now, I don't usually advocate purchasing beyond either the front week or into next week, because by the time you start, if you were to purchase 4 weeks a weekly that's 4 weeks out, you might as well buy the front month, because the premiums of the weeklies, if you multiplied that premium times 4, chances are it's going to be more than what the monthly premium would be. And so for the weeklies, I suggest that you either purchase the front month or into the next week when it comes out on Thursday, and beyond that you just let those weeklies that are listed catch up until they're either the front weekly or the one that's out, and not purchase way out in time. It's better to buy the front month if you want a little extra time. It's been my pleasure to go over this information with you. I hope that by discussing the charts and going through the patterns and keep drawing your attention to them, that they will become second nature as you begin looking at charts and seeing the patterns develop. And I wish you great trades using them. Take care.